Think your worst workday was brutal? Imagine hitting game over on a $100 million trade, the financial equivalent of crashing a Lamborghini into a wall. That's the gut punch Larry Fink survived before building finance's ultimate power tool. Aladdin didn't just emerge from a spreadsheet. It was forged in the fire of that catastrophic loss, a system so precise it turned BlackRock into an unstoppable force. By the end of this story, you'll understand how one man's disaster became Wall Street's secret weapon, and why that should keep every investor awake at night. The road from failure to dominance starts here. The $100 million mistake. It was 1988, and Larry Fink made a mistake that would change finance forever. As a young bond trader at First Boston, he bet wrong on interest rates. The trade cost his firm $100 million, massive money today, astronomical back then. Overnight, Fink went from rising star to Wall Street cautionary tale. Colleagues whispered behind his back. Competitors circled like vultures. People thought I was done, Fink would later say. But what looked like career suicide became something else entirely. The loss exposed a fundamental flaw in how Wall Street managed risk. Picture a ship captain navigating a storm with no compass. That's how traders operated. They relied on gut instinct and incomplete data, with no real systems to measure exposure. Fink's $100 million mistake wasn't an outlier. It was the inevitable result of an industry flying blind. In the 1980s, $100 million represented about 10% of First Boston's total capital. One bad trade could sink a firm. The trade involved mortgage-backed securities, where Fink misjudged how rising rates would affect their value. At the time, Wall Street had no analytical tools to properly assess this risk. When rates moved unexpectedly, losses piled up fast. After the dust settled, Fink asked the uncomfortable question. Why couldn't anyone see this coming? The answer was sobering. Trillion-dollar markets were being managed with glorified Excel spreadsheets. Risk wasn't calculated, it was guessed. This realization became Fink's obsession. He spent months analyzing what went wrong. Without proper modeling, markets were just high-stakes gambling. While others saw a pariah, Fink saw patterns. He discovered risk could be quantified if you had the right tools. The financial world wasn't ready for his ideas. When he started pitching risk management concepts, Wall Street laughed. They told me I was crazy, Fink recalled. Trading floors valued intuition over algorithms. No one believed computers could outthink seasoned bankers. Fink knew better. Math doesn't lie. While traders relied on hunches, numbers told the real story. His approach was simple. Measure every variable, run endless scenarios, and let data drive decisions. It was radical for its time. In 1988, Fink left First Boston. Most assumed his career was over. Few realized he'd already begun designing a system that would change finance forever. That $100 million loss became the foundation for BlackRock and its secret weapon, Aladdin. Here's why this matters today. The trade revealed a truth about financial markets. Without proper risk management, the whole system is vulnerable. The 2008 financial crisis would later prove Fink right in spectacular fashion. But back in 1988, he was the only one who saw it coming. The mistake taught Fink two crucial lessons. Wall Street's risk models were dangerously outdated, and whoever solved this problem would dominate finance. BlackRock became that company, and Aladdin became its engine. Let's put this in perspective. That $100 million loss would be worth about $250 million today. But the system it spawned now oversees $21 trillion, more than the GDP of the entire U.S. economy. Not bad for a failed trader. Most comeback stories involve redemption. Fink's is different. He rebuilt the game itself. The very thing that nearly destroyed him became his biggest advantage. While others saw failure, Fink saw the future. Today, BlackRock manages more money than any firm in history. And it all traces back to one bad trade in 1988. The system Fink created after his biggest failure now prevents those same mistakes for everyone else. Banks, pension funds, even governments rely on Aladdin to avoid catastrophic losses. The man who lost a fortune built the ultimate safety net. Birth of the financial god algorithm. In 1988, Larry Fink started building something Wall Street didn't know it needed. After his $100 million mistake, he realized banks were playing Russian roulette with clients' money. His solution? A system that would make blind luck obsolete in finance. That system became Aladdin. The first version ran on bulky desktop computers that look prehistoric today. But even in its infancy, Aladdin did something revolutionary. It turned risk into math. While human traders relied on experience and vague market feel, Aladdin analyzed hard data. It calculated probabilities instead of making guesses. Wall Street didn't take it seriously at first. Veteran bankers scoffed, calling it just another risk model. One Merrill Lynch exec famously sneered, "No spreadsheet replaces 20 years of market instinct." Fink, still stinging from his own costly misjudgment, knew better. He'd seen how human intuition could fail catastrophically. Early Aladdin was like upgrading from Pong to a supercomputer. It tracked every position in a portfolio, simulating thousands of market scenarios in minutes. What if interest rates rose? If oil crashed? These calculations took analysts hours, but Aladdin delivered answers in real time. The system's name spelled out its mission: asset, liability, debt, and derivative investment network. Wall Street insiders gave it a better nickname: the financial god algorithm. By 1992, BlackRock had begun licensing Aladdin to other firms. One early client slashed risk exposure by 40% without sacrificing returns. The results shocked skeptics. Before Aladdin, risk analysis meant stale spreadsheets and guesswork. Now, portfolio managers had live projections at their fingertips. The hardware was monstrous for its time, server rooms packed with overheating machines. But the payoff justified the headaches. By 1995, Aladdin managed $30 billion, while BlackRock doubled assets every 2 years, leaving traditional firms in the dust. 3 innovations gave Aladdin its edge. First, it analyzed all assets equally: stocks, bonds, derivatives. Second, it ran endless what-if scenarios. Third, it automated tedious tasks that bogged down analysts. Pension funds and insurers flocked to it first, drawn by its ability to quantify risks they'd only sensed vaguely. Soon, even Wall Street titans were calling. Critically, Aladdin didn't predict the future. It prepared for every possible one. The system didn't say, "This will happen." It said, "If this happens, here's the impact." As the 90s tech boom accelerated, so did Aladdin's capabilities. Faster computers enabled more complex models, incorporating macroeconomic data like GDP and unemployment rates, connections no human could process at scale. By 1998, Aladdin was crunching millions of data points daily, simulating thousands of scenarios before lunch. Portfolio managers treated its outputs like gospel. What set it apart was total integration. While other software handled single functions, Aladdin did everything. It became the one-stop shop for investment management. This success transformed BlackRock itself. Originally just another asset manager, it now sold tech to competitors, a strange dynamic where rivals paid to use its software. By 2000, Aladdin managed $300 billion, its original 1980s code evolving into something far more powerful. Financial historians note the irony. While dot-com mania fixated on flashy websites, BlackRock built industrial-strength infrastructure. The boring back-office system outlasted every internet stock. Each new client fed Aladdin more data, refining its models further, a virtuous cycle competitors couldn't match. The interfaces stayed notoriously complex, requiring weeks of training. But those who mastered it gained superpowers, spotting risks and opportunities invisible to others. By the 2008 crisis, Aladdin was the industry standard, managing trillions. Today's version barely resembles the original, but the DNA remains. Turn risk from art into science. What began on 1990s desktops now processes 20 million data points daily, executing orders in milliseconds. It oversees more money than any entity in history. All because Fink refused to let his $100 million mistake happen again. The God algorithm didn't just save his career. It reshaped finance forever. How Aladdin sees the future. Aladdin doesn't analyze markets like humans do. It sees connections no person would ever notice. The system combines thousands of data streams, weather reports, cargo ship movements, even political tweets, to spot risks before they hit financial statements. Most investors react to crises. Aladdin sees them coming weeks in advance. Take Hurricane Maria's approach to Puerto Rico in 2017. While meteorologists tracked the storm's path, Aladdin calculated which semiconductor stocks would plunge from factory shutdowns before the first raindrops fell. This same predictive power gave BlackRock clients a critical edge when COVID emerged. While executives planned business trips, Aladdin already knew which Asian factories would close and how supply chains would unravel. The system runs about 100,000 Monte Carlo simulations daily, testing how different events affect every asset. A typhoon in Taiwan? Aladdin knows the tech stock impacts before landfall. New German labor laws. It calculates auto industry consequences within seconds. But what makes Aladdin special isn't just processing power. It's how wildly different data points connect. Consider how Aladdin predicted the 2020 oil crash weeks early. While others watched OPEC meetings, the system spotted inventory. Buildups by analyzing satellite images of storage tanks and tracking pipeline pressure changes. Similarly, it forecasted the 2022 container shortage by noticing slight shipping delays between Shanghai and Los Angeles. Data points most investors ignored. The system's agricultural models track bee populations and soil moisture to predict crop yields better than government reports. During Russia-Ukraine tensions, it flagged Eastern European asset risks days before conventional analysts by weighting reliable news sources and tracking arms shipments. And when a series of tech CFOs resigned quietly, Aladdin spotted potential accounting issues before disclosures. Imagine markets without these insights. During COVID's peak, while human analysts struggled, Aladdin generated clear scenario analyses within days. Clients saw exactly how different outcomes would affect each portfolio holding. This preparation came from constantly comparing predictions to reality. Every crisis makes the system smarter. Aladdin's edge comes from unconventional connections. Parking lot satellite images predict employment trends before official reports. Fewer bikes outside a Chinese factory signal production issues before announcements. Meme stock activity on Reddit can predict volatility in unrelated sectors. The system sees what humans miss by analyzing everything simultaneously. The energy sector shows this best. Aladdin monitors refinery maintenance schedules, jet fuel consumption, and even business class bookings. When those dip between financial centers, market volatility often follows. Similarly, it predicted the UK pound's 2022 crisis by analyzing ATM withdrawals and capital flows weeks before the crash. Retail analysis uses foot traffic data and delivery truck movements to spot earnings trends early. Manufacturing insights come from night shift lighting patterns and equipment repair requests. But Aladdin's real power is combining these streams. While humans focus on one or two factors, the system sees global connections. BlackRock doesn't follow Aladdin blindly. Human teams review forecasts, but the results speak for themselves. Portfolios using its insights consistently outperform during turmoil. The system doesn't predict specific events, but calculates thousands of possible scenarios. When something happens, it already knows the ripple effects. Most financial disasters seem obvious in hindsight. Aladdin makes them visible beforehand, not with a crystal ball, but better math. While others react to yesterday's news, Aladdin prepares for tomorrow's crises by finding patterns in the chaos. That's why when the next crisis hits, BlackRock's clients won't be scrambling. They'll already be 3 steps ahead. The 2008 crisis, Aladdin's big break. In 2008, as banks collapsed and markets panicked, the U.S. government faced a huge problem. Nobody knew what the toxic assets were actually worth. Mortgage-backed securities had become so complex that even the banks holding them couldn't properly value them. That's when everyone turned to one system, Aladdin. The Treasury Department needed answers fast. These toxic assets were bringing down entire financial institutions. Traditional valuation methods didn't work because the underlying mortgages were too messy. Enter BlackRock and its secret weapon. While Wall Street firms were scrambling, Aladdin already had models for exactly this scenario. Aladdin could do what others couldn't. The system treated every asset as a collection of data points. It analyzed the actual loans behind each security, their default probabilities, and regional economic factors. This let Aladdin cut through the noise and calculate real values when no one else could. Banks hated this. Their balance sheets depended on optimistic valuations. Aladdin showed the ugly truth. One government official recalled, "Suddenly we could see which banks were lying about their exposure." The system revealed billions in hidden losses at institutions claiming to be solvent. BlackRock got called in because they weren't part of the problem. Unlike investment banks, they didn't hold these toxic assets. Plus, Aladdin had been stress testing similar securities for years. When the crisis hit, the system was ready. The Fed started sending BlackRock toxic assets daily. Aladdin's team would analyze them overnight and deliver valuations by morning. These reports became critical for bailout decisions. A Treasury staffer described the process. We'd get these crisp reports at 7 a.m. No fluff, just numbers. Suddenly we had clarity in the chaos. During the darkest days, Aladdin's analyses determined which firms got saved and which got left behind. This raised an uncomfortable question. What does it mean when one private system can decide the fate of banks? The data guided the infamous TARP bailouts, influencing hundreds of billions in government spending. The crisis exposed Aladdin's unique advantage. It didn't take anything at face value. Traditional rating. Agencies had slapped AAA ratings on dodgy securities. Aladdin ignored these labels and ran its own analysis. BlackRock's role surprised everyone. Before 2008, they were just another asset manager. Suddenly, government officials found themselves calling BlackRock more than Wall Street CEOs. One congressional staffer joked, "We should just put Fink on speed dial." The crisis supercharged BlackRock's growth. In 2007, they managed $1.3 trillion. By 2009, that number ballooned to $3 trillion. Much of this came from firms desperate for Aladdin's risk management after getting burned. Aladdin's cool-headed analysis contrasted with Wall Street's panic. While traders screamed and markets swung wildly, the system provided steady, data-driven answers. This calm approach appealed to institutional investors wanting stability. The government work created a snowball effect. After seeing Aladdin in action during the crisis, central banks worldwide wanted the technology. The system went global almost overnight. Here's what most people don't realize about Aladdin's 2008 role. The system didn't predict the crisis, but it was uniquely prepared to handle it. Years of analyzing complex securities meant it already had frameworks for mortgage derivatives. The crisis proved Aladdin could handle real-world stress. Academic models collapse when markets go crazy. Aladdin kept working precisely when everything else failed. This reliability made it indispensable. BlackRock's government work raised eyebrows. Some questioned whether one private firm should have so much influence. Others pointed out that BlackRock now had inside knowledge about every major bank's problems. Post-crisis regulations played right into Aladdin's strengths. New rules required more rigorous risk management, exactly what the system provided. Banks that once resisted now demanded Aladdin to comply. The numbers tell the story. In 2007, about 100 firms used Aladdin. By 2010, that number doubled. Assets under management exploded as institutions sought better risk controls. The crisis also changed how Aladdin worked. The system incorporated hard lessons from the meltdown. Future versions included better liquidity analysis and counterparty risk assessment. BlackRock's growing power concerned some watchdogs. A former SEC official noted, "They essentially became the government's brain during the crisis. Now they're marketing that same brain to everyone else." When historians analyze the 2008 crisis, they focus on banks failing and markets crashing. But the rise of Aladdin might be the most lasting impact. The system that helped clean up the mess went on to dominate finance. Today, Aladdin manages about $21 trillion, more than the GDP of the entire United States. That growth story started in 2008, when everyone realized one uncomfortable truth. Wall Street didn't understand its own risks. Your bank probably uses Aladdin too. Here's something most people don't realize. Your bank probably uses BlackRock's technology every day. JP Morgan, UBS, and other Wall Street giants all license Aladdin despite competing directly with BlackRock. It's like if Coca-Cola sold its secret formula to Pepsi. These firms could build their own systems, but they choose to pay their rival instead. Why would competitors support each other? Think of it like renting someone else's supercomputer for risk management. Building their own would require massive upfront costs and years of development. Banks realize it's smarter to license proven technology than start from scratch. Even BlackRock's toughest rivals admit they can't match the system's capabilities in-house. Here's how it works. A bank like Goldman Sachs pays BlackRock millions annually for Aladdin access. They get sophisticated analytics without development headaches. But there's a catch. Every client that joins makes Aladdin smarter through network effects. More data means better models and more accurate predictions for all users. Over 200 financial institutions now feed information into Aladdin daily, banks, insurers, pension funds, and sovereign wealth funds. The system learns from trades in Tokyo, risk models in London, and investment decisions in New York. This creates a powerful feedback loop where each new client boosts the platform's value. Banks face a simple choice: join the system and benefit from its growing intelligence, or stay outside and fall behind. Most choose to pay up rather than risk being left out. BlackRock anonymizes client data before it enters Aladdin's models, but some banks still worry about information leakage despite these safeguards. The licensing business generates serious money, over $1 billion annually from outside clients. That's pure profit since the system already exists for BlackRock's own use. Competitors essentially fund improvements to software that helps BlackRock outperform them. Here's the paradox. Banks using Aladdin get better risk management tools, but they also make BlackRock stronger. Every improvement they suggest could help BlackRock's traders too. Some firms try to limit what they share, keeping proprietary models for their best strategies. But even partial usage feeds the system's knowledge base. The widespread adoption creates standardization benefits. When everyone uses Aladdin, risk reports look consistent across firms. Pricing models use similar assumptions. Regulators like this setup. It makes oversight easier during crises when everyone works from the same data playbook. Smaller firms face tough choices. Boutique shops can't afford Aladdin's fees, putting them at an information disadvantage. Some try to replicate parts of the system, but lack the scale to compete. This creates a divide between Aladdin haves and have-nots in finance. BlackRock keeps adding features like AI analytics and blockchain integration. Clients get these upgrades automatically, making it harder for competitors to build alternatives. The licensing terms prevent reverse engineering, creating long-term dependency. Once firms build workflows around Aladdin, switching costs become enormous. Some regulators worry about systemic risk if most institutions rely on one system. BlackRock invests heavily in redundancy and cybersecurity to address this. So far, Aladdin has maintained near-perfect uptime despite its massive scale. The client list keeps growing beyond finance. Corporations managing pensions, universities handling endowments, even family offices. Future versions will offer more customizable modules, making Aladdin flexible enough for any institution. This raises an important question. When does a tool become the market itself? Aladdin increasingly defines how institutions analyze risk and value assets. As more players join, the system doesn't just reflect financial reality, it helps create it. BlackRock maintains that Aladdin operates as a neutral platform benefiting all users equally. Skeptics argue the playing field can't be level when one player owns the field. But as long as Aladdin delivers superior analytics, clients will keep paying regardless of competitive implications. BlackRock found the ultimate advantage, getting rivals to fund their competitive edge. While others chase returns, BlackRock earns steady fees from the tools everyone uses to compete. Until someone builds a better system, your bank will keep paying BlackRock for the privilege of using their rival's greatest weapon, the AI that manages your money. Here's how Aladdin manages your money without you realizing it. That index fund in your 401k? There's a 60% chance BlackRock's algorithms are making decisions about it right now. Most people don't know their retirement savings get handled by lines of code running in a data center. Think about what happens when you contribute to a retirement plan. Your money gets pooled with millions of other investors. Computers decide which stocks to buy, how much to allocate, and when to rebalance. Those decisions often come from Aladdin's models. The system analyzes thousands of factors to determine the optimal mix and executes trades in milliseconds. The scale is staggering. Aladdin influences over $7 trillion in retirement assets alone. That's more than the entire GDP of Japan. About 30 million American workers have retirement plans touched by the system, yet virtually none of them know it's happening. BlackRock didn't originally build Aladdin for retail investors. The system started as a tool for institutional money managers. But as index funds exploded in popularity, Aladdin became the engine powering passive investing. Today, it handles everything from target date funds to ESG portfolios. The automation creates efficiencies. Human fund managers might debate decisions for days. Aladdin makes thousands of adjustments per second. This speed gives BlackRock-managed funds an edge in tracking their benchmarks. But there are trade-offs. Algorithmic management removes human judgment from the equation. During the March 2020 COVID crash, this led to aggressive rebalancing that individual investors might have questioned if they'd known it was happening. The fees add up. BlackRock collects just 0.1% on average across its index funds. That seems tiny until you apply it to $7 trillion, generating $7 billion in annual revenue from retirement assets alone. Here's what most investors miss. Index funds aren't completely passive. They require constant maintenance, rebalancing, corporate actions handling, cash flow management. Aladdin automates all this drudge work at massive scale. What looks like set it and forget it, to you involves countless behind-the-scenes computations. The system handles tricky situations automatically. When a stock gets added to the S&P 500, dozens of funds must buy it. Aladdin coordinates these purchases to minimize market impact. Your dividend payments get processed too. The system tracks thousands of securities to ensure funds collect and distribute income properly. During the meme stock craze, Aladdin kept dutifully rebalancing funds to include GameStop and AMC as their weights increased. The system followed its programming regardless of how irrational prices became. Environmental, social, and governance, ESG, investing relies heavily on Aladdin. When you choose an ESG fund, algorithms decide which companies qualify based on BlackRock's interpretation of the standards. Some criticize this setup. People deserve transparency about algorithms controlling their life savings, says one consumer advocate. But disclosures remain buried in fine print few investors read. BlackRock benefits either way. When markets rise, more money flows into index funds. When markets fall, Aladdin's risk management attracts nervous investors. The system positions the firm to profit in all conditions. Retail investors get a strange deal. They pay extremely low fees for professional-grade portfolio management, but they surrender control in the process. Your 401k might get handled by the same system that manages sovereign wealth funds, just with different settings. The convenience comes with concentration risk. As Aladdin handles more retail assets, its decisions affect more individual investors. BlackRock maintains multiple redundancy systems to prevent widespread issues. Few people question the arrangement because it works. Retirement accounts managed by Aladdin consistently deliver market returns minus tiny fees. For most investors, that's enough. The machinery stays invisible as long as the results meet expectations. This represents finance's quiet revolution. Wall Street used to mean men in suits yelling on trading floors. Today, it's servers humming in data centers running BlackRock's code. The average investor benefits from lower costs, but has less insight into how their money gets managed. Your life savings get managed by code you'll never see, using models you'll never understand, running on servers you'll never visit. For better or worse, this is modern investing. The $100 million central banks come that spawned Aladdin when countries are about to go broke, they don't call their economists first, whether you knew it or not. During the European debt crisis, Greece, Ireland, and Portugal all turned to Aladdin to understand their financial mess. Central bankers needed answers no one else could provide, and BlackRock's system became their financial translator. The European Central Bank faced a nightmare scenario in 2010. Greek bonds had become radioactive. No one dared touch them, and traditional models couldn't price the risk. "We were flying blind," admitted one ECB official. The solution? They brought in Aladdin to assess the bonds. The system treated government debt like any other asset, cutting through political claims with cold calculations. When Greek officials insisted their debt was sustainable, Aladdin's report showed a 72% chance of default within 5 years. That analysis became the foundation for bailout negotiations. Across Europe, Aladdin became the go-to tool for sovereign risk management. Ireland used it to untangle its collapsing banks, separating toxic property loans from viable assets. The Swiss National Bank relied on it to track reserves, while Norway's sovereign wealth fund, the world's largest, runs entirely on BlackRock's technology. What started as crisis software became everyday infrastructure for governments. The system's real power emerged in modeling bailout scenarios. During heated debates about Greek debt forgiveness, Aladdin projected each option's long-term effects. One official described watching the numbers shift. Seeing 2030's debt-to-GDP ratio change in real time made abstract arguments concrete. These projections shaped decisions affecting millions, with Aladdin serving as the neutral referee nobody could dispute. This government reliance created strange dynamics. Ministers found themselves taking orders from a private company's algorithms. During one negotiation, talks stalled when Aladdin's analysis contradicted political promises. The system's influence grew so pronounced that critics began questioning the concentration of power. How had a Wall Street firm become the arbiter of national finances? The pattern repeated globally. During COVID, the U.S. Treasury tapped BlackRock to value thousands of troubled corporate bonds overnight. The Bank of England paid millions for urgent Aladdin reports during the 2022 UK pension crisis. Each emergency deepened the dependency, with former BlackRock executives now holding top jobs at central banks worldwide. Developing countries present a particularly striking case. Nations building sovereign wealth funds often adopt Aladdin rather than develop their own systems. The software comes preloaded with decades of institutional knowledge they couldn't recreate, but also carries subtle assumptions that shape economic policies. One African finance minister described it as buying a financial philosophy along with the software. Climate change shows where this is heading. As central banks assess global warming's financial impacts, Aladdin already tracks climate risks for investors. It's now being adapted to model green bailouts and sustainable stimulus programs. BlackRock carefully frames this as neutral data provision, but the implications are profound. Private software guiding public policy on existential threats. The contracts stay discreet, the influence growing quietly. Unlike flashy Wall Street deals, government consulting happens behind closed doors. Recent projects include designing digital currencies and climate stress tests, each one feeding more data to train Aladdin's models. Here's the paradox. A system built to prevent financial disasters now profits from them. BlackRock gets called when everything goes wrong, charging premium fees to help pick up the pieces. That original $100 million mistake created a company that thrives on others' crises. What began as a bond risk tool now helps steer economies. Central bankers might make the final calls, but they increasingly rely on Aladdin's math. The genie isn't going back in the bottle, and with each crisis, its grip tightens. The BlackRock Brain Trust. Here's how Aladdin's brain works better than anyone else's. Every client that joins the system makes it smarter. Banks, pension funds, sovereign wealth funds, they all feed data into the same machine, creating a financial nerve center unmatched in global markets. Consider this real-world example. When 3 banks in Asia start buying Taiwanese semiconductors while 2 European funds dump South Korean tech stocks, Aladdin spots the connection instantly. Human traders might see isolated moves, but the system recognizes the pattern, perhaps anticipating a coming chip shortage or geopolitical tensions. It processes 20 million data points daily, from stock trades to weather reports, seeing connections others miss. BlackRock's advantage comes from synthesis. Where competitors see fragments, Aladdin assembles the puzzle. A. Midwest drought might seem unrelated to European auto stocks, but the system tracks how crop failures raise biofuel demand, which impacts ethanol prices, which affects German manufacturers using corn-based plastics. Most banks analyze slivers of this chain. BlackRock sees the entire domino effect. The system's knowledge extends beyond finance. Shipping patterns in Singapore, factory outputs in Mexico, even political protests in Chile, all feed into Aladdin's models. This lets BlackRock spot trends early, like predicting a tech rally weeks before earnings reports based on semiconductor shipments from Taiwan. Network effects cement the advantage. Each new client enriches the system's data pool, making predictions sharper for everyone, but giving BlackRock the clearest view. Anonymization supposedly protects client secrets, but skeptics argue aggregated data still offers unfair insights. When a crisis hits, Aladdin's breadth provides stability. It distinguishes panic from real risk, like recognizing a sell-off stems from one fund's liquidation, not systemic weakness, letting BlackRock profit while others overreact. Recent AI upgrades find deeper patterns. Machine learning might link Brazilian soybean prices to lumber futures months later, or tie air pollution levels in Beijing to pharmaceutical stock movements. These aren't guesses, they're correlations mined from decades of backtested data, a historical archive rivals can't match. This creates an impossible choice for competitors. Use Aladdin and feed BlackRock's advantage, or go solo and fall behind. Most choose dependency. Even rivals pay millions annually for the platform. Knowing their data makes the system smarter, for BlackRock most of all. Employees describe eureka moments when Aladdin flags hidden risks. A bond trader might get alerts about obscure Italian debt, only to learn days later about a brewing banking crisis there. Such precision breeds reliance. While startups boast of big data, none match BlackRock's clean, real-time streams refined over decades. The system improves like a veteran trader. Each crisis teaches new lessons coded into its algorithms. Future upgrades will add satellite imagery and supply chain sensors, widening the gap further. Regulators fret about one firm holding this much insight, even as they increasingly rely on Aladdin themselves. That $100 million mistake started it all. Today, Aladdin quietly shapes decisions affecting trillions, spotting risks before they emerge and opportunities others overlook. Clients fuel this machine willingly, creating a paradox. The more indispensable Aladdin becomes, the harder it is to replace. We now live in markets BlackRock understands better than anyone, a global brain born from algorithms in a data center. Weather reports for your portfolio. Here's something you might not expect. Aladdin monitors weather patterns just as closely as stock prices. Remember when Typhoon Doksuri slammed into Taiwan last year? While news outlets showed flooded streets, Aladdin was calculating how factory shutdowns would create a global shortage of computer chips. Within hours, it automatically adjusted tech holdings across thousands of portfolios. The connection between weather and markets runs deep. Take agriculture. Aladdin watches parched fields in Brazil like a farmer scanning the sky for rain. If soil moisture drops below critical levels, the system predicts soybean shortages months before harvest. Commodity traders using this data gain weeks of lead time on competitors waiting for government reports. Droughts create ripple effects Aladdin spots early. When China's Yangtze River runs low, the system knows shipping costs will spike. That means higher prices for everything moved by barge, from coal to car parts. Where humans see separate events, Aladdin builds connections into risk models automatically. Hurricanes trigger instant portfolio shifts. As a storm barrels toward Houston, Aladdin calculates probable refinery outages and adjusts energy holdings before the first raindrops fall. These decisions happen in milliseconds, faster than any human reaction. Remember Texas 2021 freeze? Aladdin had already flagged vulnerable power plants weeks before the blackouts. Investors who heeded these warnings avoided billions in losses, while others scrambled. Shipping routes depend on whether Aladdin tracks. The system monitors ocean currents like a captain plotting a course. When storms delay Asia to Europe shipments, it predicts which retailers will face empty shelves. This isn't guessing, it's calculating transit times down to the hour. Commodity traders live by this data. Coffee prices jump when frost threatens Brazilian crops. Orange juice futures surge before Florida hurricanes make landfall. Aladdin knows exactly how many cold nights a cocoa crop can withstand. Knowledge refined over decades of data. Energy markets react fastest. A single pipeline freeze in Canada can spike natural gas prices across continents. Aladdin tracks vulnerabilities most investors miss, like which power plants lack winterization or which gas fields ice over first. Insurance portfolios get weather-tested constantly. Aladdin simulates thousands of disaster scenarios. Wildfires burning through California suburbs, floods swallowing German towns. Each simulation adjusts claim probabilities and reserve requirements with precision no actuary could match. Agricultural insurance relies on this data. The system tracks Ethiopian droughts as closely as Wall Street watches the federal drought patterns in Africa get analyzed alongside crop futures in Chicago, helping banks manage farm loan risks globally. Recent upgrades added real-time satellite monitoring. Now Aladdin spots stressed crops before farmers report problems, giving traders an edge in predicting supply shocks. Droughts affect more than food prices. When European rivers run low, Aladdin flags potential chemical plant closures. Many German factories rely on river water for cooling, a connection most analysts overlook. Renewable energy needs weather data most. Solar output drops when wildfire haze dims the sun. Wind farms underperform during unusual pressure systems. Aladdin models these variances to predict green energy cash flows. The system tracks microclimates too. It knows which California vineyards sit in fog pockets that prevent frost damage. data that prices agricultural derivatives with pinpoint accuracy. Weather risks get priced into bonds. Coastal city municipal bonds now include climate resilience assessments. Aladdin models how rising seas could impact tax bases decades ahead. Human analysts can't match the scope. That heat wave in India? Aladdin sees it straining power grids, cutting factory output, and disrupting shipping lanes simultaneously. The system's historical database is unmatched. Decades of climate market correlations let it spot patterns, like how El Niño boosts Peruvian mining stocks while hurting Australian wheat farmers. Disaster response gets quantified. After major earthquakes, Aladdin models impacts on insurers and governments before damage assessments arrive. Even snowfall matters. The system tracks winter accumulation because spring runoff feeds hydroelectric dams. Less snow means less summer power, a connection most portfolios ignore. Energy traders exploit these insights. Aladdin alerts them when heat waves will spike electricity demand, allowing perfect timing of plant investments. Retail investors feel these effects too. Your index fund gets silently rebalanced as Aladdin adjusts for weather impacts worldwide. The system anticipates. By monitoring ocean temperatures, it predicts hurricane likelihood months ahead, letting insurers adjust reserves proactively. Farming cooperatives rely on this data for planting decisions. Agricultural lenders use the same models to assess risks. The military even takes interest. Aladdin's weather mapping helps predict supply chain vulnerabilities during conflicts, because bad weather wins wars too. New data sources keep feeding Aladdin's models: satellites, buoys, soil sensors. Each upgrade makes its predictions sharper. Quant funds trade on tiny weather edges. Some buy grain futures based on rainfall forecasts. Others short airlines before snowstorms. This isn't speculation, it's science applied to finance. Weather stops being unpredictable when analyzed properly. BlackRock's edge comes from integration. Where others see weather data, Aladdin connects it to specific assets and supply chains. The system knows which stocks will move when storms form over Nebraska. Farmers now compete against algorithms. Grain prices adjust before harvests begin, thanks to Aladdin's yield predictions. The takeaway? Modern investing means tracking typhoons as closely as earnings reports. Your portfolio already does. You just didn't know it. Those weather reports you skip? Wall Street watches them like hawks. So next time you check the forecast, remember, BlackRock's already 10 steps ahead. The system connected money to the physical world in ways we're still discovering. And that genie isn't going back in the bottle. The $21 trillion shadow. Let's talk about a number so big it's hard to grasp. $21 trillion. That's how much money flows through Aladdin today. To put that in perspective, it's more than the entire U.S. economy produces in a year. One system now controls nearly 10% of all the world's invested wealth. How did we get here? The growth happened so fast most people missed it. In 2008, Aladdin managed about $6 trillion. Today that number more than tripled, adding roughly $1 trillion in new assets annually. At this rate, it could oversee $30 trillion before 2030, an unprecedented concentration of financial power. Here's what that scale means. Aladdin oversees more money than the next 5 asset managers combined. The system executes trades, rebalances portfolios, and shifts allocations across thousands of funds simultaneously. Central banks monitor its operations closely. Some economists compare its market influence to that of a central bank. But unlike the Fed, Aladdin answers to shareholders, not taxpayers. The $21 trillion breaks down revealingly. $9 trillion from BlackRock's own funds, $7 trillion from competitors using Aladdin, and $5 trillion from government and institutional clients. Nearly every corner of finance touches the system now, with growth fueled by both traditional investing and licensing as more banks join the platform. This concentration creates an uncomfortable reality. Markets increasingly move as Aladdin decides. When the system flags a risk, hundreds of institutions react similarly, creating herd behavior at staggering scale. Diversity of opinion, once a market strength, diminishes by the year. BlackRock frames this as efficiency. Critics warn of single-point vulnerabilities where one error could ripple across the entire financial system. Consider the human impact. About 60% of U.S. retirement assets connect to Aladdin, influencing how millions will spend their later years. The system manages assets across 100 countries, shaping European pensions, Asian sovereign wealth, and African infrastructure projects through its algorithms. Yet most account holders never realize their connection to this financial leviathan. Network effects accelerate the growth. Each new client improves Aladdin's data advantage, attracting more clients in turn. Competing systems can't catch up, creating a self-reinforcing cycle. About 100,000 financial professionals now use Aladdin daily, their careers increasingly tied to mastering its outputs. The human element persists, but in service to algorithms. Security concerns multiply with scale. A $21 trillion system makes an attractive target, prompting BlackRock to spend billions annually on cybersecurity. One successful hack could destabilize markets worldwide. Small investors feel the effects too, whether through 401k holdings or stock prices influenced by Aladdin's moves. The political dimension grows clearer as BlackRock advises governments and former employees take regulatory roles. This revolving door blurs lines between private profits and public oversight. Economic theorists debate whether Aladdin is financial infrastructure or dangerous concentration of power. The truth likely lies between. The $21 trillion milestone forces a question. Should any single system hold this much influence? Markets thrive on competition, yet we're moving toward a financial monoculture with unknown consequences. BlackRock argues Aladdin brings stability, preventing crises like the $100 million loss that sparked its creation. But the genie isn't going back in the bottle. We're just beginning to understand what this concentration means for the future of money. The cybersecurity nightmare. Imagine this. One security breach could shake the entire global economy. That's the nightmare scenario when one system controls $21 trillion in assets. Aladdin isn't just BlackRock's problem. It's the financial system's biggest single point of failure. BlackRock combats constant cyber threats with extreme measures. The system uses behavioral biometrics tracking keystrokes, mouse movements, and even phone handling. In 2021, this stopped an attack when intruders with correct passwords failed to mimic human typing patterns. Physical security matches digital rigor. Data centers have retina scanners, armed guards, and Faraday cages blocking signals. Employees need multiple authentications just to enter server rooms. Here's how Aladdin's layered defenses work. 1. Microsegmentation. Unlike traditional networks, breaches are contained in isolated sections. It's like separate vaults for each client instead of one room full of money. 2. AI monitoring. Algorithms spot real-time anomalies, like unauthorized tweaks to risk models, catching what humans might miss for weeks. 3. Insider protocols. Extreme vetting and activity monitoring ensure employees can't go rogue. Suspicious behavior triggers instant lockdowns. 4. Third-party controls. Partner banks must follow strict security, though compromised endpoints, like a banker's laptop, remain weak points. 5. Encryption. Multiple layers render stolen data useless without quantum decryption keys that change every few minutes. State-sponsored hackers pose the gravest threat. Chinese and Russian teams, armed with near-unlimited resources, constantly probe Aladdin. During the Russia-Ukraine war, BlackRock's cybersecurity team worked triple shifts anticipating spillover attacks. So far, no public breaches have occurred, but attempts grow more sophisticated yearly. Smaller incidents still happen. In 2020, hackers briefly accessed a client portal, exposing personal data. BlackRock responded by overhauling authentication globally. The company spends an estimated $500 million annually on security, employing former NSA analysts and counterintelligence specialists. Yet, vulnerabilities persist. Social engineering, like phishing emails, bypasses tech defenses by tricking employees. BlackRock runs internal drills, staging fake attacks to keep staff alert. Software updates also introduce risks. Developers spend equal time patching holes as building features. Quantum computing looms as the next frontier. Future machines could crack today's encryption, so BlackRock is already developing post-quantum cryptography. Meanwhile, regulators watch nervously. They share threat intelligence, but can't mandate defenses for Aladdin's proprietary system. Backup systems provide a safety net. Redundant data centers across regions ensure seamless transitions if one is compromised. Hackers would need simultaneous global attacks to cause lasting damage. A near impossible feat, the stakes keep rising. As Aladdin manages more assets, the payoff for breaching it grows. Economists warn of a hack of the century scenario where the reward justifies any resource expenditure. Investors rarely consider this hidden war. Your retirement portfolio's safety hinges on anonymous programmers outmaneuvering hackers daily. For all the doomsday scenarios, Aladdin's record remains clean, but the threats evolve faster than defenses. One uncomfortable truth remains. Our financial system depends on one company's perpetual vigilance. If BlackRock's team ever slips, the consequences could dwarf 2008's crisis. That's the trade-off for centralized efficiency, a risk that keeps regulators awake at night. Your money is safer than ever, until the moment it's not. And the next crisis might not start on Wall Street, but in a hacker's basement. Larry Fink's story should have ended in 1988. That's when the rising star bond trader lost $100 million on a single bad bet at First Boston. In Wall Street's cutthroat world, that kind of failure usually buries careers forever. But Fink did something unusual. He turned his biggest humiliation into his ultimate weapon. The trading floor that once celebrated him now avoided eye contact. Most Wall Street casualties slink away quietly. Fink stayed and obsessed over one question in his cramped office above a Manhattan pizza joint. How did no one see this coming? The stale smell of pepperoni mixed with printer toner as he pored over spreadsheets, determined to build something from his failure. BlackRock started with just 8 employees fighting for desk space in that tiny office. Their early pitch was simple: we'll prevent what happened to Fink from happening to you. Potential clients scoffed at focusing on risk instead of returns. One banker famously threw their prospectus in the trash mid-meeting, the papers fluttering to the floor as Fink watched silently. The first years were brutal. Fink mortgaged his house to keep the lights on, the hum of old fluorescent bulbs soundtracking late nights. Most mornings began with the same ritual: wiping pizza grease off keyboards while questioning whether his risk management obsession would ever pay off. Aladdin changed everything. The clunky 1990s software that Wall Street laughed at became BlackRock's Trojan horse. While competitors chased hot stocks, Fink's team quietly built financial infrastructure. We weren't the smartest guys on Wall Street, Fink admitted. We just focused on what everyone else ignored. The 2008 financial crisis proved Fink right in the most dramatic way possible. While Lehman collapsed and Bear Stearns burned, suddenly everyone needed what BlackRock sold. The same banks that mocked Fink's risk tools now begged for access. Overnight, Wall Street's outsider became its most indispensable player. BlackRock's growth tells the comeback story best. From $30 billion under management in the 1990s to $10 trillion today. The little risk firm now towers over banking giants that once dwarfed it. JP Morgan's Jamie Dimon jokes that Fink went from Wall Street's punching bag to its godfather in one career. Fink's second act keeps evolving. His annual letters to CEOs now make headlines worldwide. Critics call this hypocrisy. BlackRock still invests heavily in fossil fuels. Supporters say it shows Fink's willingness to adapt. The numbers don't lie. BlackRock generates about $5 billion in annual profits. The company he founded after his worst failure now manages more money than the next 5 competitors combined. That $100 million loss looks like the best investment Wall Street never made. Fink still thinks about that trade daily. Not with regret, but as a reminder. Fear keeps me honest, he told a Stanford business class. While competitors chase short-term wins, Fink stays fixated on long-term survival. That mindset turned BlackRock into Wall Street's tortoise that beat every hair. The business world loves comeback stories. Fink's redemption arc stands apart. He rebuilt how the entire financial system operates by focusing on what everyone else wanted to avoid: failure. Wall Street still tells cautionary tales about the $100 million trade. But now they're about the guy who learned from it, not the one who blew it. BlackRock's rise reveals finance's inconvenient truth. The industry worships winners, but gets built by people who've lost big and learned bigger. Fink's edge came because of his failure. While rivals chased perfect records, he built systems to survive imperfection. The meetings tell the full story. 30 years ago, Fink sat outside waiting for bank executives who couldn't spare 5 minutes. Today, those same bankers wait hours for his calls. From punching bag to power player in one career. Fink's influence now extends beyond finance. His warnings about retirement crises influence policy. The once-mocked risk manager now gets taken seriously on everything from climate change to infrastructure, all because he refused to let one bad trade define him. The real measure of Fink's comeback isn't the $10 trillion. It's that Wall Street now sees risk management as exciting as trading. The industry that shunned Fink now copies everything he built. There's a lesson here beyond finance. Fink proved that early failure only defines you if you let it. His career shows that sometimes the worst moments plant seeds for the biggest comebacks. That $100 million loss didn't end his story. It created the plot twist that made it legendary. 35 years later, that trade looks different. Not as a career ender, but as the moment that reshaped global finance. Fink built a system to prevent others from repeating his mistake. That's the ultimate Wall Street redemption. The ESG Double Game. Here's how BlackRock plays both sides of the sustainability game. Larry Fink writes heartfelt letters about corporate responsibility each year. Meanwhile, Aladdin quietly manages billions in oil stocks and defense contractors. This isn't an accident, it's by design. Fink's annual CEO letters made him an unlikely climate spokesman. His 2020 letter declared climate risk as investment risk, while the 2021 version demanded sustainability disclosures. These statements position BlackRock as Wall Street's ESG leader, but their $260 billion in fossil fuel holdings tell the real story. They remain the top investor in Exxon, Chevron, and BP, optimizing these holdings for maximum returns through Aladdin's profit-driven algorithms. The contradictions cut deeper than mere hypocrisy. While promoting social responsibility, BlackRock manages $18 billion in weapons manufacturers and voted against 90% of climate resolutions last year. At ExxonMobil, they opposed a shareholder proposal requiring emissions targets aligned with the Paris Agreement. Despite Fink's public climate pledges, Aladdin operates like a double-edged sword, one side polished with ESG rhetoric, the other sharpened by pure financial calculus. The system analyzes oil companies for profitability and volatility, never carbon emissions. When Ukraine needed missiles, defense stocks soared, and Aladdin's algorithms automatically capitalized on the surge without ethical consideration. Environmental groups call this greenwashing with good reason. Only 3% of BlackRock's assets follow strict sustainability guidelines. Their ESG funds often just apply minor mathematical adjustments, holding the same oil companies but weighting them slightly less. A recent study found these sustainable portfolios performed only marginally better environmentally than regular ones. Worker pensions expose the shell game. Public retirement funds demanding fossil-free investing get steered into green-labeled products, while BlackRock simultaneously manages nearly identical non-ESG versions using the same Aladdin models. Teachers' pensions end up indirectly funding the very energy stocks they sought to avoid. The voting records prove where priorities lie. BlackRock supported just 10% of climate resolutions at energy firms they owned in 2021. They opposed 88% of proposals limiting executive pay last year. When profits conflict with principles, the algorithms choose profits every time, because that's how they were designed. Fink acknowledges the tension, arguing engagement beats divestment. But after years of this approach, BlackRock's fossil fuel investments keep growing. Their climate-aware funds still hold oil companies, just with creative labeling. The oil boom of 2022 saw money flood back to traditional investments as sustainable funds underperformed, and Aladdin rebalanced automatically toward better returns. The defense sector reveals the strategy's limits. No amount of shareholder engagement will turn Raytheon into a peace advocate. Yet BlackRock remains the top investor in major weapons manufacturers, a fact conspicuously absent from Fink's letters. Some insiders admit the truth. "We're trying to change capitalism from within," one executive explained, while an analyst anonymously called ESG mostly marketing. Portfolio managers face no penalty for ignoring sustainability if traditional funds perform better. Compensation still ties solely to returns. Recent political pressure forced minor concessions, like offering some fossil-free options. But these represent a tiny fraction of assets. The core business remains unchanged because Aladdin's neutral algorithms enable this duality. They don't care about contradictions, just cold equations. The ultimate test comes in shareholder votes. When activists proposed actual changes at oil companies, BlackRock consistently sided with management. Their much-touted engagement produces minor tweaks rather than fundamental shifts, like supporting non-binding emissions reports while opposing production caps. Fink himself embodies these contradictions. He owns multiple private jets while championing carbon reduction. His compensation ties to BlackRock's stock price, not emission cuts. The math never lies. A system designed to maximize returns was never going to seriously combat climate change. So next time you read Fink's sustainability letter, remember the algorithms powering his business. They don't have moral qualms, just profit calculations. And those numbers keep leading back to oil stocks, weapons makers, and tobacco companies. Aladdin works exactly as intended, and that's precisely the problem. Inside the Aladdin code, let's crack open the hood of the machine running your money. Aladdin's codebase looks nothing like the financial software of even 5 years ago. It's a Frankenstein monster of cutting-edge tech, part AI, part blockchain, with quantum computing experiments running in the background. The system that started as Excel on steroids now uses technology most banks don't understand. BlackRock employs more machine learning, PhDs than some universities, spending $500 million annually on AI R&D. These algorithms rewrite their own code based on what works, like neural networks that predict market moves by scanning satellite images of parking lots. Others translate Federal Reserve speeches into trading signals before the words finish echoing in the room. Security operates like a digital fingerprint scanner. It tracks typing patterns, mouse movements, even how you hold your phone. In 2021, this stopped a major breach when the system flagged an intruder based on keystroke patterns alone. The hacker had all the right passwords, but couldn't fake human behavior. Quantum computing experiments resemble performing calculus on a house of cards. Partnering with IBM, BlackRock tests quantum algorithms that could solve complex risk calculations in seconds instead of hours. The technology remains unstable, but could revolutionize portfolio optimization. Blockchain integration transformed settlement systems, cutting transaction times from days to minutes. Private blockchains create audit trails so detailed they make traditional accounting look primitive. This technology quietly became the backbone for securities transactions. Only 200 people out of 18,000 employees have access to Aladdin's core programming. Developers work in isolated teams that only see pieces of the system. No single person understands everything. Even CEO Larry Fink reportedly needs multiple approvals for certain sections. Compliance systems run a constant tech arms race. Algorithms scan transactions in real time, catching insider trading patterns before humans notice. Some hedge funds complain the system won't allow trades that violate rules. It automatically adjusts portfolios when laws change. Natural language processing digests 50,000 news articles daily across 100 languages. The system extracts market-moving details from earnings calls before transcripts publish, even analyzing CEO voice tones during interviews. A shaky delivery might trigger automated position reductions before bad news breaks. The hardware could power a small nation, with 12 global data centers and 10,000 dedicated servers. Each facility has electromagnetic shielding and backup generators that can run for 30 days without outside power. BlackRock's annual electricity bill exceeds some countries' budgets. Trading algorithms operate at hummingbird speeds, executing orders in 0.0003 seconds. The system breaks large trades into thousands of microorders to hide activity, sometimes predicting competitors' moves and front-running them subtly. Risk models consume most computing power, running 100,000 daily simulations testing portfolios against potential crises, market crashes, wars, even asteroid impacts. The system knows exactly how your investments would fare if China invaded Taiwan tomorrow. 3 engineering teams compete on every upgrade, with the best solution implemented and second place becoming backup. This Darwinian approach keeps innovation relentless, though about 80% of Aladdin still runs on physical servers due to cloud security concerns. Despite cutting-edge tech, the user interface looks straight out of 2005, prioritizing function over form. What it lacks in flashy graphics, it makes up in raw processing power, analyzing streaming data from 200 markets simultaneously. Data pipelines swallow everything from satellite imagery to shipping manifests. One subsystem tracks factory output by counting trucks and parking lot photos, while another monitors oil tanker movements through satellite radar signatures. Testing protocols recreate the 2008 crash daily and simulate simultaneous cyber attacks on 3 continents. New code undergoes 17 validation steps before deployment, quality control that would make NASA proud. The corporate structure reflects technological priorities, with more engineers than portfolio managers. Tech staff receive bonuses tied to system uptime rather than investment returns. When the CIO speaks, even senior traders listen. Software updates happen daily, sometimes tweaking calculations by 0.0001% for better accuracy. Yet beneath the shiny tech, parts still run on 1950s-era COBOL code, too critical to replace but requiring archaeology degrees to maintain. Human oversight provides the final checkpoint. Aladdin flags opportunities, but portfolio managers click execute, combining machine speed with human judgment. The system tailors interfaces to each user, learning individual work patterns like automatically displaying oil prices at 9 a.m. for traders who always check them. Disaster recovery plans include mobile data centers in armored trucks, designed to withstand multiple regional catastrophes. During 9/11, BlackRock relocated critical systems within hours. Today's protocols are even more robust. Competitors have no chance. JP Morgan spent $12 billion trying to build a rival before giving up. As others license Aladdin instead of fighting a losing battle, BlackRock's tech lead grows yearly. The system optimizes purely for returns, buying tobacco or defense stocks without moral judgments if the math supports it. Future upgrades aim to see around corners better than any human, analyzing political developments and scientific papers for opportunities years before commercialization. What began as risk software now resembles a financial singularity, blurring the line between tool and trader more each year. The BlackRock revolving door. Here's something that would make any conspiracy theorist's head spin. The line between BlackRock and government has gotten so blurry, you need a spreadsheet to track who's working where. Former Treasury secretaries, Fed officials, even central bankers, they all seem to end up at BlackRock eventually. Consider this. Since 2000, 47 senior government officials have joined BlackRock, including 2 Treasury secretaries, 3 Fed presidents, and multiple European regulators. Meanwhile, the Biden administration alone hired 4 senior BlackRock staffers. This two-way pipeline gives the firm unprecedented access. The COVID bailouts showed how this plays out in crisis. When the Fed needed someone to manage its corporate bond buying program, they hired a BlackRock-run firm staffed by former Fed and Treasury officials. These were the same people who designed financial rescue packages, now implementing them for their new employer. One former regulator admitted anonymously, "We knew their systems. There wasn't time to train anyone else." Europe followed the same pattern. BlackRock got hired to conduct bank stress tests while simultaneously managing assets for those same banks. When bureaucrats raised conflict concerns, they were told no other firm had the necessary technology. Government contracts provide Aladdin with something money can't buy: insider knowledge. The system learns how regulators think during crises and gains access to non-public market data. This makes Aladdin smarter than competitors because it gets trained on information others never see. Retirement plans reveal another layer. BlackRock manages pension money for multiple government agencies while advising those same regulators. Security clearances add to the advantage. Many ex-government hires keep access to sensitive economic data when joining BlackRock. The scale is institutional now. Regulatory filings show BlackRock holds hundreds of official government meetings yearly. No other asset manager comes close. During the pandemic, they received emergency contracts without normal bidding processes. One congressional staffer noted, "When crisis hits, everyone reaches for the same Rolodex." This creates subtle power shifts. Former BlackRock staff helped draft banking rules they once lobbied against. Treasury appointees understand Aladdin's models better than government systems. The knowledge imbalance shapes policy in ways that favor existing frameworks over new approaches. Defenders point to disclosure requirements. BlackRock complies with all revolving door laws. But legal compliance doesn't address the systemic issue. When one firm employs both rule makers and rule enforcers, public oversight weakens. The numbers tell the story. 47 officials switching sides, hundreds of government contracts, trillions in managed public pension assets. This isn't mere influence. It's fusion between state and financial power. Wall Street veterans quietly question the arrangement. As one former SEC official put it, "We used to joke that Treasury had a BlackRock desk. Now it's not a joke." Yet alternatives seem impractical. Governments have become dependent on Aladdin's technology. The implications extend beyond any single company. When private firms capture regulatory knowledge, innovation suffers while incumbents thrive. Rules get written favoring systems already in place. Nobody voted for this system. It happened gradually, one hire, one contract at a time, until the alternative became unthinkable. That's how revolutions occur, not with protests, but with LinkedIn updates and consulting agreements. The $100 million mistake that built Aladdin created something its makers never intended, a private company that governments can't function without. Think about that next time you check your retirement account. The same people setting fiscal policy might be managing your money. The revolving door keeps spinning because both sides benefit. Governments get instant expertise. BlackRock gains market insight. Only the public sits outside this arrangement, watching as the line between Wall Street and Washington disappears. Corporate defenders argue this improves policy. Maybe. But it definitely improves BlackRock's position. The company that knows regulators best will always navigate rules easiest. And right now, nobody knows regulators better than their former colleagues. This isn't illegal. It's not even secret. But it does raise questions about whose interests get prioritized when crisis hits. In finance, the next crisis is always just around the corner. The quiet takeover of global finance is complete. All it took was one revolving door that never stops spinning. When algorithms outthink humans. Here's something that should blow your mind. Wall Street's top jobs are disappearing faster than middle managers at a tech startup. Aladdin already automates about 80% of what junior analysts used to do. And the scary part? It's getting better at the remaining 20% every single day. Let's talk about how algorithms are eating finance alive. Jobs reports tell the ugly truth. BlackRock cut 3% of its workforce last year, mostly in research and portfolio management. Meanwhile, their tech teams keep expanding. The writing's on the wall. Human stock pickers are going the way of elevator operators and switchboard attendants. The changes start small but add up fast. Remember when earning your CFA meant job security? Now Aladdin's algorithms pass those same tests in minutes. The system analyzes 10,000 stocks before most analysts finish their morning coffee. Humans can't compete with that scale, and firms are noticing. Credit decisions show where this is heading. Banks used to employ armies of loan officers. Now Aladdin's AI models approve mortgages in seconds using 1,000 data points, far more than any person could process. Same goes for corporate loans, credit cards, even complex derivatives. The machines simply see more. Trading floors look like ghost towns. Where hundreds of traders once shouted orders, now just a handful monitor screens. Aladdin executes 90% of BlackRock's trades automatically based on risk parameters. When the system spots an opportunity, it acts in milliseconds, no human hesitation. Portfolio construction got fully automated. Human managers used to debate asset allocations for weeks. Now Aladdin optimizes portfolios using machine learning trained on 100 years of market data. During the March 2020 crash, it automatically liquidated risky positions while human managers were still panicking, saving clients billions. The hardest pill to swallow? The algorithms keep learning. Every trade Aladdin makes gets analyzed. Good decisions get reinforced, bad ones get tweaked. It's like having a fund manager who improves daily without vacations or salary demands. No wonder executives love this. Even client interactions are getting automated. Aladdin's natural language processing handles basic investor queries. More complex questions get routed to human staff. But the AI handles about 60% of routine communication already. Those customer service jobs aren't coming back. The scariest part? The system builds its own strategies now. Early versions just followed human-programmed rules. Today's Aladdin spots market patterns no one taught it to find. One algorithm discovered that semiconductor delivery delays predict inflation better than government reports. Humans never made that connection. Corporate meetings look different now. Analysts show up with Aladdin-generated questions printed on tablets. The system listens to earnings calls, instantly flags inconsistencies, and suggests follow-ups. One CEO complained that the robots ask tougher questions than the humans ever did. Salary structures reflect the shift. Tech staff at BlackRock now earn 30% more than traditional finance roles with similar experience. Python coders out-earn portfolio managers. The message is clear. The money's in maintaining the machines, not stock picking. Client reporting got handed to algorithms. Those glossy quarterly reports? Aladdin generates them in minutes, complete with customized commentary. Performance attribution, risk analysis, even the executive summaries, all automated. The humans just approve the final PDF. The remaining humans face impossible pressure. Portfolio managers who trail benchmarks get replaced by algorithms that track them perfectly. Analysts who can't add value beyond Aladdin's outputs get shown the door. It's survival of the fittest, and the fittest are mostly code now. Some firms push back. A few hedge funds still swear by human intuition, but their performance is slipping. Last year, 78% of active managers underperformed the S&P 500, the worst showing in decades. Investors are noticing and moving money to cheaper, algorithm-driven strategies. BlackRock's own workforce tells the story. In 2010, 2/3 of employees had finance backgrounds. Today, over half come from tech. The company hires more data scientists than economists. When a quant dies at BlackRock, they don't replace him. They upgrade his algorithms instead. Client demands drive this shift. Pension funds no longer pay 2% fees for human stock pickers. They want cheap, reliable index tracking, exactly what algorithms excel at. The same clients pushing fees down are pushing automation up. It's a vicious cycle for human workers. The future of finance isn't humans working with computers. It's computers working with better computers. And at the center of it all, Aladdin, the system that ate Wall Street one job at a time. That $100 million mistake didn't just create a company. It created the template for the post-human financial world. And if you work in finance, you should be very worried. The ultimate financial cheat because the machines aren't coming anymore. Here's the thing about Aladdin. They're already here. Calling it financial and they're getting smarter while you watch. It's like calling the Death Star a flashlight. BlackRock built the ultimate financial operating system from a $100 million mistake, and now it controls more money than most countries. JP Morgan spent $12 billion trying to replicate Aladdin before giving up and paying BlackRock to use theirs instead. That's the pattern. Competitors burn cash while Aladdin gets stronger. The system processes more data before breakfast than most banks see all year. Satellite images, shipping manifests, even truck speeds at factory gates. While others stare at stock charts, Aladdin tracks Brazilian rainfall and North Sea winds. The genius is in the feedback loop. Banks pay millions annually to use Aladdin, and every trade they make improves the system. It's like Burger King paying McDonald's to use their grills while every Whopper made improves Big Mac recipes. That licensing business brings in over $1 billion yearly in pure profit. Clients can't quit. Switching costs would bankrupt them. Entire risk departments train on Aladdin. Reports format data specifically for it. Aladdin's processing power is terrifying. It runs 100,000 market scenarios daily, recomputes risk exposures every 15 minutes for $21 trillion in assets, and digests earnings reports before they hit news wires. Some hedge funds just copy its trades. Why think when you can leech? The irony is delicious. Larry Fink took Wall Street's ultimate humiliation, that $100 million loss, and turned it into his superpower. While rivals chased flashy trades, he obsessed over failure prevention. Now his boring risk software prints money while their genius trades blow up. Governments cemented Aladdin's dominance. When the Fed needed to value toxic assets in 2008, Aladdin. COVID corporate bond bailouts? Aladdin. Next crisis. Guess who's getting that 3 a.m. panic call? BlackRock hires more coders than MBAs now. Last year's layoffs hit human stock pickers while tech teams expanded. Here's what competitors miss. Aladdin isn't a product. It's financial infrastructure, like the electrical grid. Once that status locked in, the game was over. Even regulators use it to oversee. Well, itself basically. The revenue model would make a mobster blush. Charge clients to use the system, use their data to improve it, then use those improvements to outperform them. Rinse and repeat. That $100 million loss created more value than 100,000 winning trades could. By failing spectacularly early, Fink built something that can't fail now. The ultimate revenge on Wall Street's "What have you done for me lately" culture. Check your portfolio. There's a 60% chance BlackRock algorithms manage part of it. You didn't choose this system. Nobody voted on it. It just happened. One bank, one pension fund, one government contract at a time. Final thought. The best cheat codes come from finding glitches. Fink found Wall Street's glitch. It fears losing money more than it loves making it. He's been exploiting that for 35 years. That's not software. That's the financial equivalent of finding unlimited lives in Contra. And nobody's found the reset button yet. So here's the trillion-dollar question. Is Aladdin the hero finance needs, or a disaster waiting to happen? That $100 million mistake built a system now woven into the fabric of global wealth, managing pensions, guiding governments, and reshaping markets. The genie's out of the bottle. Aladdin keeps evolving, making decisions that ripple through your 401k and national economies alike. The real issue isn't its dominance, but whether we've truly reckoned with handing this much power to algorithms. How do you feel knowing this system might control your financial future? Drop your thoughts below, and hit like if you want to see where this financial revolution heads next.